When the stock market drops, what should you consider as normal and when should you be concerned? As an investor, we should anticipate that our portfolio will drop at some point. But when you see your portfolio drop day after day, week over week, even for the most experienced investor, it can be quite disconcerting. When you see your portfolio drop by $1,000, $10,000, or even $100,000, that can sometimes be quite worrying. But large stock market drops have been happening for decades. The reason might be different, but the result is the same, a large decline in portfolio value. We can use these historical results to understand what is normal for an investment portfolio and how much we should anticipate our portfolio could drop by in the future. Now, there are three important factors that influence how much a portfolio might decline if the stock market drops, if there's a correction, or if there's a recession. So the first factor is diversification. Diversification is going to have a big impact on how much the portfolio will drop. The second factor is asset allocation. Asset allocation also is going to have a big impact on the variability, how much the portfolio goes up and down. And the third factor is, are you in the accumulation phase when you're adding to the portfolio, or are you in the decumulation phase where you're withdrawing from the portfolio in retirement? These three factors have a huge impact on how big a drop would be considered normal for an investment portfolio. So we're going to take a look at these three factors in more detail. Now, the first factor is diversification. So for a poorly diversified portfolio, there is a chance that the portfolio could drop to zero. But for a globally diversified, highly diversified investment portfolio, we would expect that the portfolio would never go to zero. For the portfolio to go to zero with a globally diversified investment portfolio, it essentially means that the entire global economy has gone to zero. And at that point, we've got some bigger problems. Now, this is an example of how a globally diversified investment portfolio might behave in the future. Every line here represents one historical period of investment returns. You'll see that even for a globally diversified portfolio, there can be some big drops in the future, but we would never really expect the portfolio to go completely to zero. We might expect some 30 or 40% drops depending on asset allocation, but you can see that all the lines eventually continue upward as the global economy continues to grow. Now, the second important factor when understanding how big a drop in your investment portfolio is considered normal is what your asset allocation is. Now, asset allocation refers to your mix between equities and fixed income. So the more equities, the higher the risk for the portfolio, and the larger we should expect the portfolio could drop in the future. As a general rule, an investor should expect that their portfolio could decline by about half the equity allocation. So for a 100% equity portfolio, we might expect that portfolio to decline by about 50% at some point. For an 80-20 asset allocation with 80% in equities and 20% in fixed income, we might expect that portfolio to drop by about 40% at some point. And for a 60-40 portfolio with 60% in equities and 40% in fixed income, we might expect that sort of portfolio to drop by about 30% at some point in the future. Now, the third factor that's going to impact what normal is in terms of a stock market drop or stock market correction is whether or not you're in the accumulation phase or the decumulation phase. Now, if you're in the accumulation phase and you're still adding to your investment portfolio, this is going to mute the impact of a stock market drop or a correction. By adding to your portfolio during a correction, you're going to actually take advantage of the lower equity prices, and that's going to help mute the impact of a drop in your portfolio value. Now, on the other side, if you're in the decumulation phase, having a stock market drop or a stock market correction can be a very big risk. This type of risk has its own name and its sequence of returns risk. The sequence of your investment returns that you experience right before retirement or right after you retire in early retirement has a really big impact on whether or not you run out of money in the future. This type of risk is so large that it sometimes requires changes to spending in retirement to make sure that you don't run out of money in the future. If you're using the Plan Easy platform to create your financial plan, then we want to go to the success rate analysis, and we want to understand in retirement, what is the chance of running out of money in the future based on your unique circumstances. So let's take a look. So in this example, we've got a retirement plan starting at age 60, and we're going to take a look at the success rate. So you can go to Final Plan, Projections, and then Success Rate. And what we want to do is we want to understand how a poor sequence of investment returns in early retirement could impact a financial plan or retirement plan. And so this analysis looks at different periods of historical investment returns, and it takes into account the unique characteristics of this financial plan. So when they're starting CPP, old age security, and how much they want to draw from the investment portfolio each year. And you can see this couple's in a good position. They've got just over $2 million in financial assets. They want to draw that down up until age 100. And this plan has a success rate of 90%, so that's quite good. There's some chance of running out of money, but it's not until their early 90s that becomes a big risk. Now, this plan does experience some large drops in portfolio value. So we can see here that some of these lines, they represent challenging periods like the Great Depression or high inflation of the 1970s. In these sort of situations, which can be very challenging for a retirement plan, there is a chance of running out of money in the future, and we would need to make some changes to discretionary spending to maybe make sure that we don't run out of money at some point in the future. Now, this plan looks quite good. So most scenarios, you can see most of these lines are well above zero, and there's no real risk of running out of money unless this couple were to experience a very poor series of investment returns in early retirement. But let's take a look to see what happens if their spending expectations were a little bit higher. So let's go down here and let's go down to the expenses section, and we're going to add in $12,000 in discretionary spending, and we're going to do that till the end of the plan. So we're going to assume that they're spending more every year. What we want to do is we want to see how that impacts the success rate of the financial plan. So in this case, with $12,000 in extra discretionary spending, we're going to see the success rate drop. And so from 90%, we're now at 69% success rate, and there's a much higher chance of running out of money in the future. So with this extra spending, a period of poor investment returns, a large stock market drop, a recession, a correction, or an early retirement can have a very big impact on their financial plan, potentially running out of money as early as their late 70s or early 80s. Now, this scenario is still possible. We're just pushing the limit on their discretionary spending. So now there would be more need to decline that discretionary spending, to decrease that discretionary spending in early retirement if they had some poor investment returns. But let's see what happens if we push that spending up just a little bit more. So let's do $18,000 a year in extra discretionary spending. We're going to do that up to the end of the plan. And now we're going to see how that impacts the success rate. So we went from 90% to 69%. Now with an extra $6,000 in spending, we're down to 50% success rate. So you can see here, almost half of these historical periods will run out of money at some point in the future with that extra $18,000 in discretionary spending. And this really highlights how important the withdrawals are during the decumulation phase, because if the withdrawals from a retirement plan are too high, it can very quickly lead to running out of money in the future if faced with a poor sequence of investment returns. So a poor period of investment returns, a stock market drop, correction, recession in early retirement, or even right before retirement can have a very detrimental effect on a retirement plan. Now, if you want to create your own retirement plan, your own success rate analysis, go to planeasy.ca, click Start Planning, and see if we're a good fit. And then you can create your own financial plan on the PlanEasy platform and work with an advice-only financial planner. Thanks for watching.